Disclaimer. Pop quiz. What happens when the world's second largest economy decides to lock down exports of a metal that our entire technological future depends on, while the world's most important trading hub is still recovering from the worst delivery crisis in modern history, and futures brokers in Shanghai just set margin requirements at levels never seen before? We're about to find out, and the timeline is exactly 16 days from now. On December 12th, 2025, something extraordinary happened that most Americans completely missed. Shanghai futures brokers set margin requirements on silver contracts at 26%. Let me put that in perspective for you. That's the highest margin requirement in recorded history for silver futures trading. We're not talking about a small adjustment here. This is brokers telling traders they need to put up more than a quarter of their position's value in cash, right now, today. Think about what that means. If you wanted to control a $100,000 silver position, you'd need to have $26,000 sitting in your account just to hold that position. That's not normal market behavior. That's the financial equivalent of emergency brakes screeching. But here's where it gets interesting. While Shanghai brokers are slamming on those brakes, the Chinese government just dropped a bombshell that changes everything about how silver moves around our planet. The Ministry of Commerce issued Announcement 2025-68, and buried in that bureaucratic language is a rule that kicks in on January 1st, 2026. Starting in 16 days, any company wanting to export silver from China needs a state-issued license, and they're not handing those licenses out like candy. You need to prove you produce at least 80 tons of silver annually just to qualify. According to the ministry's official documentation, this effectively removes the vast majority of smaller refiners and traders from the export market. Here's what should grab our attention. China isn't some minor player in silver. We're talking about the country that controls approximately 60 to 70% of global silver flows. That's not my estimate. That's based on data from the World Bureau of Metal Statistics tracking physical delivery patterns across major exchanges. China doesn't just mine silver. They refine it, process it, and most importantly, they've become the middleman connecting mines in South America and Africa to manufacturers in Europe and North America. When China closes that valve in 16 days, we're not losing a small slice of supply. We're potentially losing the majority of the metal that keeps our factories running. Now you might be thinking, okay, margins are high and China's restricting exports, but markets adjust, right? Supply chains adapt. That's usually true. But here's the problem. Our silver markets were already hanging by a thread before any of this happened. Let me take you back to October 2025, just 2 months ago. London, the historical heart of precious metals trading for centuries, faced something that shouldn't be possible in modern markets. They ran out of silver, not low inventory, not tight supplies. They literally couldn't fulfill delivery obligations to buyers who had legitimate contracts demanding physical metal. The London Metal Exchange doesn't like to advertise when they're in crisis mode, but the data tells the story. Emergency airlifts had to move 53.88 million ounces of silver from New York and Shanghai to London just to prevent complete system collapse. Think about the logistics of that for a moment. We're talking about loading massive amounts of physical metal onto cargo planes and flying it across oceans on emergency schedules, because the vaults that are supposed to have centuries of accumulated reserves couldn't meet their obligations. According to exchange delivery reports from October, some buyers were waiting 2 to 3 weeks for metal they had already purchased and paid for. Here's what keeps me up at night. Those emergency airlifts happened in October. We're in mid-December now, and current free-float inventory in London, that's the metal actually available for trading and not locked up in exchange-traded funds, remains at dangerously low levels. The temporary patch worked, but it didn't fix the underlying problem. Delivery delays of 2 to 3 weeks are still persisting, according to recent market reports from London-based dealers. That shouldn't be happening in functioning markets. When you buy something, you should get it. These delays tell us the vaults are still running on fumes. So we've got Shanghai brokers panicking with 26% margins. We've got China about to shut off 60 to 70% of global silver supply in 16 days. And we've got London still struggling to fulfill basic delivery obligations 2 months after their worst crisis in modern history. That's already a perfect storm. But there's a fourth element that makes this fundamentally different from every previous silver shortage. This isn't a speculative bubble. This is industrial demand that's not going away. Have you noticed how every tech company is suddenly building massive data centers? We're not talking about small server rooms. According to industry projections from major tech infrastructure firms, artificial intelligence requires computing power on a scale we've never seen before. These data centers need electricity, and they need it 24 hours a day, 7 days a week. Solar arrays have become the preferred power source for these facilities. And here's the connection most people miss. Every 500 megawatt solar array backing these AI data centers requires approximately 300 metric tons of silver. That's from manufacturing data published by solar industry associations tracking material inputs. Microsoft, Google, Amazon, Meta, and dozens of other tech giants are committing more than $2 trillion to data center build-out through 2030. These aren't speculative investments that might get canceled if markets turn rocky. These are completed construction projects and signed contracts with delivery timelines. The servers are being installed, the solar arrays are being built, and every single one of those arrays needs silver to function. This creates a demand floor that didn't exist during previous silver shortages. When the Hunt brothers tried to corner the silver market back in 1980, industrial users could wait them out because demand was flexible. Today's demand isn't flexible. You can't run an AI data center without electricity, and you can't build modern solar panels without silver. Let me connect this directly to your life. That data center demand isn't abstract. Every time you use artificial intelligence tools, stream movies, or use cloud services, you're depending on infrastructure that requires silver. The companies providing those services know they need to secure supply, or their expansion plans collapse. They're not trading silver for profit. They're buying it because their business model requires it. According to the Silver Institute, we're looking at structural industrial demand that represents a permanent shift in how silver gets consumed rather than recycled back into markets. So here we are. Shanghai brokers are demanding emergency margin levels because something's breaking in their market. China's about to cut off the supply valve that feeds global markets. London's vaults are barely hanging on after October's delivery crisis. And industrial users need silver for infrastructure that powers our digital economy, creating buyer competition we've never seen before. Each of these factors alone would be concerning. All four happening simultaneously with China's export restrictions kicking in exactly 16 days from now. That's not a potential problem. That's a mathematical certainty that's about to reshape how silver markets function. The question isn't whether something's going to break. The question is, which domino falls first? And what happens to the price of silver and our investments tied to precious metals when these three crises collide at exactly the same moment on January 1st, 2026? Now, let's talk about numbers that don't lie. Because when I tell you that Shanghai's margin spiked to 26%, isn't just brokers being cautious. I need you to see exactly what's happening in those warehouses that back these futures contracts. The Shanghai Futures Exchange publishes daily warehouse stock reports, and the data from December 11th, 2025 shows 780 tons of silver sitting in their registered vaults. That might sound like a lot of metal until you realize what it used to be. In January 2021, those same warehouses held 3,091 tons. We're down 75% from that peak. That's not a gradual decline. That's a systematic draining of the physical metal that's supposed to make paper contracts worth something. Here's what makes this terrifying. While inventory dropped 75%, trading volume exploded to the highest levels we've seen since May 2024. According to Shanghai Futures Exchange volume data, more contracts are trading hands than at any point in the last 7 months. Think about what that means mathematically. You've got more people making bets on silver, writing contracts promising to deliver metal, and there's less actual silver sitting in the warehouses to back those promises. Market analysts tracking the exchange estimate the leverage ratio, that's paper contracts compared to physical inventory, has reached approximately 50-1 during peak trading sessions. Let me make that ratio real for you. Imagine 50 people each holding a receipt saying they own 1 ounce of silver, but there's only 1 actual ounce sitting in the vault. That works fine as long as most people are happy just holding paper receipts and never asking for the physical metal. But what happens when even 10% of those receipt holders show up demanding their silver? The vault can't deliver. Someone's getting a cash settlement instead of metal, whether they want it or not. That's not a futures market anymore. That's a game of musical chairs where 49 out of 50 people are going to be left standing when the music stops. And that 26% margin requirement on December 12th, that's the sixth margin hike Shanghai brokers have implemented in 2025 alone. According to exchange regulatory filings, each previous increase happened when leverage ratios exceeded sustainable levels and brokers needed to reduce the number of speculative positions. 6 times this year, they've looked at their books and decided there's too much paper floating around compared to physical metal. 6 times they've tried to cool things down. And now they're at the highest margin requirement in recorded history because none of those previous attempts worked. The paper keeps piling up while the metal keeps disappearing. But Shanghai's inventory problem isn't happening in isolation. This is a global shortage, and we've got hard numbers proving it. The Silver Institute, which tracks worldwide supply and demand data from mining operations and industrial consumption, projects a 187 million ounce supply deficit for 2025. That's the 5th consecutive year we've been burning through more silver than mines can produce. 5th year in a row. Let that sink in. We're not talking about a temporary shortage caused by a mine strike or a pandemic disruption. This is structural imbalance that's persisted through 5 different market cycles. When you add up those 5 years of deficits from 2021 through 2025, we're looking at a cumulative shortfall approaching 820 million ounces. To put that in perspective, global silver mines produce about 850 million ounces per year, according to the World Silver Survey. We've essentially consumed 10 months of total global mine production, more than what's been pulled out of the ground. That metal had to come from somewhere, and the answer is, it came from above-ground stockpiles, exchange warehouses, and investor holdings. Those reserves that took decades to accumulate are being drawn down to feed industrial demand that keeps growing year after year. Now, here's the piece that makes China's export restrictions absolutely devastating. Remember those 820 million ounces we've already burned through? A significant portion of that deficit was covered by Chinese refined silver, flowing into Western markets. China doesn't just control 60 to 70% of current silver flows. According to customs data analyzed by metal tracking services, Chinese refiners have been the release valve that prevented this deficit from triggering a crisis years ago. When London needed metal in October, emergency airlifts came partly from Shanghai. When COMEX warehouses in New York run low, they source metal from Chinese refiners. That safety valve closes permanently in 16 days, when MOFCOM Announcement 2025-68 takes effect, requiring state licenses and minimum 80-ton annual production to export. Think about the timing here. We've got 5 consecutive years of deficits already draining reserves. We've got Shanghai warehouse stocks down 75%. And now, we're about to cut off the supply line that's been papering over these shortfalls. There are no significant new silver mines coming online until 2027 or 2028, according to mining industry development schedules. The metal that's supposed to close this gap doesn't exist yet. It's still in the ground, waiting to be discovered and developed. We're looking at a minimum 2-year window where structural deficits continue without Chinese supply able to fill the gaps. Want proof this shortage is already causing real pain? Let's talk about what happened in London during October's delivery crisis. The London Metal Exchange doesn't advertise their internal stress, but lease rate data tells us everything we need to know. Silver lease rates, that's what it costs to borrow physical metal for short-term delivery, spiked above 40% annualized during the height of October's crisis. 40%. That means someone needing to borrow silver for just 1 month was paying the equivalent of a 40% annual interest rate. According to exchange settlement data, spot premiums over futures contracts reached $3 per ounce during that crisis period. We haven't seen premiums that wide since the Hunt brothers tried to corner the market back in 1980. Those numbers aren't academic statistics. They represent real companies, real traders, real manufacturers who desperately needed physical silver and couldn't get it at normal prices. They had to pay massive premiums and borrowing costs just to fulfill their obligations. And here's what should scare us. Current borrowing costs haven't gone back to normal levels. London silver lease rates are still elevated at 0.8 to 1.2%, according to recent bullion bank quotes. That's structural tightness that temporary inventory injections couldn't resolve. The October airlifts bought time, but they didn't fix the underlying shortage. Let me connect this to what you're seeing in your own investment accounts and retirement portfolios. If you've got any exposure to silver through mining stocks, ETFs, or physical holdings, you've already seen incredible gains this year. Silver's up 109% year to date as of mid-December 2025, trading around $63.91 per ounce. That's not speculative mania driving prices higher. That's industrial users, manufacturers, and institutional buyers looking at these deficit numbers and realizing they need to secure supply before the shortage gets worse. According to Commodity Futures Trading Commission, data tracking large trader positions, commercial hedgers who normally sell silver to lock in mining production have actually been net buyers in recent months. That's mining companies buying silver on the open market. Think about how backward that is. The people who produce the metal are buying it because they're worried about future availability. You might be wondering, can't we just recycle more silver to cover these deficits? That's a logical question, and here's the problem. The Silver Institute's consumption data shows that modern industrial applications, particularly electronics and solar panels, create products where silver recovery is economically unviable. You can't efficiently extract the tiny amounts of silver from a discarded phone or broken solar panel. It's there, but getting it back costs more than mining fresh silver. Unlike gold, which gets recycled at rates above 90% because it's primarily used in jewelry and bars, silver's industrial consumption represents metal that's functionally lost from the supply chain. Every ounce going into an AI data center's solar array is an ounce that won't be available for future markets. So here's where we stand with 16 days until China's export restrictions activate. Shanghai warehouses are down to 780 tons, with 50-to-1 leverage ratios, and the sixth margin hike of 2025 failing to stabilize their market. Global deficits have consumed 820 million ounces over 5 consecutive years, with no new mine supply arriving until 2027 at the earliest. London lease rates remain elevated months after October's delivery crisis, proving the shortage is structural rather than temporary. And Chinese supply, that's been the safety valve preventing complete market collapse, is about to disappear behind export licensing requirements that eliminate most refiners from global trade. The data isn't predicting a crisis. The data is showing us a crisis that's already here, getting worse by the day, and about to lose its primary relief mechanism when the calendar turns to January 1st, 2026. This isn't speculation. This is mathematics. Let's talk about dates and timelines, because when you understand the calendar, you'll see exactly why this situation has no good exit. January 1st, 2026 is 16 days away. On that date, China's Ministry of Commerce export restrictions become law. Every refiner wanting to ship silver out of China needs a state license requiring proof of at least 80 tons of annual production. According to MOFCOM's regulatory framework, most smaller refiners won't qualify, removing 60 to 70% of global silver supply from Western markets the moment the calendar changes. Now, let's do some basic math on Shanghai's timeline. Those 780 tons in Shanghai Futures Exchange warehouses can support approximately 2 to 3 weeks of current trading volume based on exchange data. 2 to 3 weeks. Shanghai potentially exhausts available physical inventory in early to mid-January, right when Chinese export restrictions eliminate the ability to source replacement metal from domestic refiners. Think about what happens when a futures exchange runs out of inventory. Traders expecting physical delivery suddenly get cash settlements instead. That destroys confidence in paper markets immediately. When physical delivery becomes impossible, contracts stop representing actual silver and become pure financial derivatives with no connection to real metal markets. And here's the critical piece. When Chinese exports cut off on January 1st, London and COMEX exchanges face simultaneous delivery demands they cannot fulfill without accessing Chinese metal. Remember October's crisis when London needed emergency airlifts of 53.88 million ounces? Part of that rescue came from Shanghai. That emergency option disappears in 16 days. Let me walk you through the price mathematics. Silver's already up 109% year to date at $63.91 per ounce, and that rally happened before China's export restrictions were finalized, and before Shanghai margins hit emergency levels. We're looking at structural deficits of 820 million ounces by end of 2026, according to Silver Institute forecasting. Now, add the AI infrastructure demand. Tech companies have committed over $2 trillion to data center build-out through 2030, with each 500-megawatt solar array requiring 300 metric tons of silver. That demand isn't negotiable. These companies can't run artificial intelligence without electricity, and they've already signed contracts and started construction. Here's the conservative price trajectory. Current spot at $63.91 per ounce. The structural deficit combined with Chinese export restrictions, removing 60 to 70% of supply flows, points toward $85 to $100 per ounce by Q2 2026. That's basic supply-demand economics when you cut available supply by more than half while industrial demand continues growing. But that assumes orderly market adjustment. What happens if industrial users panic? What if companies building AI data centers look at the January 1st restrictions, Shanghai's 26% margins, and London's delivery delays, and decide they need to secure 6 months of silver supply immediately? According to CFTC data, manufacturers typically carry only 30 to 60 days of inventory. If they suddenly try to secure 6-month buffers, we're looking at buying pressure that could push silver to $150 to $200 per ounce by year-end 2026. Let me make that personal for you. If you've got retirement savings in silver, we're potentially talking about your holdings doubling or tripling over the next 12 months. But here's the catch. Not all silver exposure is created equal when markets start breaking. Paper contracts and ETFs that don't actually hold physical metal allocated to you specifically become worthless the moment exchanges can't deliver. You're holding a promise that someone else will give you silver, but if warehouses are empty, that promise gets settled in cash at whatever price the exchange decides. The endgame scenarios are limited, and none are good for paper market integrity. First, exchanges keep raising margins beyond Shanghai's 26%, potentially to 30, 40, even 50% of contract value. At some point, only industrial users and major institutions can afford to participate, shutting retail traders out entirely. Second, exchanges implement delivery restrictions, limiting how much physical metal any contract holder can take, with the rest forcibly cash settled. Third is the nuclear option. Exchanges announce cash settlement-only structures for silver contracts. Paper silver becomes purely speculative with no connection to physical metal. The price on your screen represents what traders think silver is worth, but you can't actually get silver at that price because there's no delivery mechanism. And that brings us to premiums. During London's October crisis, spot premiums over futures reached $3 per ounce. Someone wanting physical silver paid $3 more than quoted market price just to get actual metal. When Chinese exports shut off and exchanges implement delivery restrictions, we're looking at premiums widening to $10, $15, maybe $20 per ounce over official spot prices. At that point, you've got a permanent two-tier market where paper silver and physical silver are completely different assets with completely different prices. This bifurcation creates something we haven't seen in modern precious metals markets: physical silver trading as a strategic industrial commodity with pricing determined by direct producer-consumer contracts rather than exchange benchmarks. Mining companies stop selling on COMEX or London Metal Exchange entirely. They sign long-term supply contracts directly with industrial users, with prices negotiated privately. The price quoted on financial news becomes irrelevant because actual metal trades in a parallel market that retail investors can't access. According to commodity structures in critical materials like rare earth elements, this direct contracting model is exactly what happens when supply becomes too constrained for open exchange trading. Here's what this means for your money over the next 12 months. If you're holding physical silver, actual coins or bars you can touch, you're positioned for a scenario where premiums widen dramatically and physical metal becomes difficult to source at any price. Bullion dealer inventory reports show premiums already climbing above historical averages before Chinese export restrictions even activate. If you're holding paper silver through ETFs or futures that don't guarantee allocated physical metal, you're exposed to counterparty risk and potential cash settlement at prices that might not reflect what physical metal actually trades for when markets bifurcate. Let me bring this back to where we started. Shanghai brokers set 26% margins on December 12th because they're staring at 780 tons supporting 50-to-1 leverage. China's export restrictions activate in 16 days, removing 60 to 70% of global supply. London's still struggling with delivery delays months after October's crisis. And industrial users need 300 metric tons of silver for every solar array backing the AI infrastructure powering our digital economy. These aren't separate problems that might resolve independently. They're interconnected pressures converging at exactly the same moment on January 1st, 2026. The mathematics of structural deficits totaling 820 million ounces, the physical reality of empty warehouses, and the industrial demand that won't disappear point toward a silver market that looks completely different 12 months from now. The question isn't whether silver reaches $100 or $150 per ounce. The question is whether paper markets maintain credibility when they can't deliver physical metal, whether retail investors get cash settled out of positions at unfavorable prices, and whether price discovery shifts from exchanges to direct contracts that exclude everyone except major industrial buyers. We're about to find out if modern commodity markets can survive a shortage in a critical industrial metal when the usual safety valves get permanently shut off. 16 days from now, we'll have our answer. And based on everything we've seen, Shanghai's margin spike to 26% on December 12th wasn't brokers overreacting. It was brokers acknowledging mathematical reality before everyone else figured it out. The collision is coming. Make sure you understand where your silver exposure really is, because paper promises and physical metal are about to become very different things.